Okay, the big news of the Bank of Canada cut is over. So what happens next? What happens to rates? Because let's face it, most of the rates that we work with, mortgage rates we work with every day, are not related to prime. They're not related to the Bank of Canada at all. Majority of rates in Canada are fixed mortgage rates. The majority of rates that people take right now at renewal or on purchase of a home are fixed rates, and typically short-term fixed rates. Like some people are as short as 1 year, and probably the most popular term right now is 3 year. But there's some 5 year fixed rates being sold. But let's break it down. What happens next? Like if the prime rate of the Bank of Canada drops, and now all the banks, all the big lenders have matched the Bank of Canada change. So that's a new prime rate in Canada. And every variable rates come down 0.25%, and every HELOC is down 0.25%. So yeah, that's all in place. But what about the fixed rates? Okay, so a little bit of a lesson on fixed rates. Fixed rates are based on bond yields. Bond yields are the Canada government bonds. So they come in different terms. There's a 1 year bond, there's a 2 year bond, there's a 10-year bond, there's a 5 year bond. And that's the government's and trading these bonds is done by private enterprise. It's done mainly by the big banks, but it's also done by banks all over the world. So because it's a commodity, it's a government bond commodity that can trade anywhere and everywhere, but the main action is in Canada. So what happens? It's whether bonds are being sold or bonds are being bought, and at what price? At what price? Because basically what you say to yourself, well, wait a second, it's a bond. Like, is it just one price? Sure, but there's something called a yield, and the yield is how the bond is priced for the coupon. So coupon's there, but what's the value? What's the value of it? The coupon is set, but what's the value of that? And that's where the yield comes from. So at the end of the day, those are being traded every single day. Billions and billions of dollars worth every single day. So the yields are what dominate fixed rate mortgages. And those are printed. There's a number of different sites you can go to and look at the bond yields. Here's the thing. They don't instantly filter through because, like, if you're not a trader if you're in a treasury department creating mortgages. You have to have an idea where you're going to be a week from now, a day from now, 2 days from now. And therefore, you're not just going to see a sudden movement in bond yields and say, all right, let's change everything this afternoon. You wait, you watch, you see, okay, where is this trend settling in? Where is it going to be? And that normally takes a couple days after a major event like a central bank rate change. It's got to settle in. Well, it's pretty much priced in because it was, hey, if I was a betting man, I'd almost bet there was a leak because every trader in the country seems to know. Yes, it was well known the bank would probably move, but let me tell you something. There was a dead certainty about this rate drop that I have not seen in a long time. Like, there was no trader caught by surprise. I guarantee that. Anyway, priced in and down now. All bond yields are down. All Canadian bond yields, Government of Canada bonds yields are down as of today. So what does that shake out to? It shakes out to lower rates for Canadians, but it takes a few more days for these rates to get published. Some have just come in today. They'll come in again on Monday. So that'll just keep on coming through the course. And sometimes it does take 2 or 3 days to really know where the bottom rates are. Right now, we're seeing 5-year insured. So that's when you're purchasing a home with less than 5% down, less than 20% down. And that's dropped all the way down to 4.49 for a 5-year. 3 years about 4.69, and we'll probably see further drops than that. And if you're using 20% down as a purchase and it's under $1 million, we're looking at numbers like 4.84, 4.74 for a 5-year, 4.99, 4.89 for a 3-year. So those numbers are coming down. We used to always talk about these 3-year rates being just over 5, 3-year fixed just over 5, 5.09, 5.19. They have come down. So will they come down much further? Got to wait and see. But there is some room opening up. Margins are tight. The banks aren't making a ton of money, but there's some room opening up. So this brings us to the question of, well, okay, if there's going to be more cuts, then isn't variable a good idea? Okay, let's break it down. There will be another cut, whether it's going to be September or I'm not so sure July is the next date, but if it's September, sure, then it's down half a point from 5. It's 4.5, and okay, that's moving in the right direction, but probably it will slow down because the U.S. Fed typically does nothing in September and October because of the U.S. presidential election. So then we've got, okay, the Fed starts to cut, the U.S. Federal Reserve starts to cut their rate, their policy rate by December. If we get one cut in, well, then kind of opens it up for Canada to follow. So how far could it go? So in simplicity, barring all kinds of bad geopolitical events, the simplistic idea, barring geopolitical events that bring inflation back, there's lots of that stuff can happen. Like seriously, wars screw things up. So maybe we see a 3% Bank of Canada prime was started at 5, so it's down to 3 by the end of 2025. That would mean lower fixed rates, but it would mean a lower variable rate. It would be a variable rate that's somewhere in the 4s. It would be HELOCs that's lower. So, by the way, the commercial banks add 2.2 to all those rates. So if we have a 3% Bank of Canada rate, then we've got a 5.2% commercial prime, less than knock a percent off. That's 4.2. So we're going to see a lot of rates in the 4s, but I don't know when we're going to see rates in the 3s again. So should somebody take a variable today? It's just too soon. We've got to let the patterns more establish themselves, and eventually there may be time to discuss a variable, but not today.